The market's irrationality isn't just an external force. It's a deep, often invisible, current within our own psychology. We, as investors, frequently find ourselves reacting to market volatility not as detached analysts, but as creatures of instinct, as prey caught in a sudden storm. Millions of us, despite the best intentions and the most diligent research, watch our portfolios dwindle during downturns. This isn't typically because our analysis was flawed, or because the underlying value of our investments vanished overnight. It is, more often than not, a consequence of deeply ingrained emotional responses that sabotage our best efforts. This journey today isn't about predicting the unpredictable winds of the market. It's about something far more fundamental and far more within our control: mastering the self. We'll move beyond generic advice and delve into the specific psychological mechanisms that compel investors to sell in a panic, often at precisely the worst possible moment. We will equip you with data-driven, actionable strategies to build what we can call an emotional moat around your investments, a defense against the very impulses that lead to costly mistakes. As the venerable Benjamin Graham wisely stated in The Intelligent Investor, the investor's chief problem, and even his worst enemy, is likely to be himself. Today, we confront that internal adversary head-on. We will identify the specific psychological traps that lead us to lose battles before the market even has a chance to truly test our resolve. We will explore the insidious nature of loss aversion, the seductive pull of herd mentality, the deceptive anchoring effect of recency bias, the often unseen illusion of control, and the paralyzing force of confirmation bias. And crucially, we will understand precisely how each of these manifests as the urge to panic sell. The first invisible chain that binds investors, compelling them to panic sell, is the tyranny of loss aversion. This isn't a mere preference, it's a deeply wired survival instinct. Neuroeconomists have shown that the brain's response to a loss is significantly more potent than its response to an equivalent gain. The amygdala, our fear center, flares up with losses, creating a primal urge to escape, to stop the perceived threat. This potent bias makes us intensely averse to experiencing even temporary drawdowns in our portfolios. When our carefully curated investments begin to dip, this amplified psychological pain can easily override rational thought. The urge to stop the bleeding becomes overwhelming, leading many to sell at precisely the moment when doing so locks in losses and sacrifices the potential for a future recovery. We see this play out repeatedly. Investors liquidating sound assets not because their fundamental value has deteriorated, but purely out of emotional distress. While the advice to cut your losses has merit, loss aversion can twist this into a frantic, irrational liquidation. To counter this, we must practice a form of emotional rebalancing. Instead of viewing a drawdown solely as pain, reframe it. Employ a mental accounting strategy. Imagine your portfolio as belonging to a separate account, one specifically designed to withstand temporary fluctuations. Visualize the long-term growth trajectory, the upward march of compounding, rather than fixating solely on the immediate discomfort. This is akin to practicing premeditatio malorum, contemplating potential losses asterisk before asterisk they occur, building a psychological resilience that can withstand the storm. Think of loss aversion like a deep-sea diver's fear of the crushing pressure of the abyss. The rational mind understands the safety of the submersible, but the primal fear screams to ascend, even at the risk of decompression sickness. Building our emotional moat means reinforcing the hull of our financial submersible and practicing controlled, rational responses to the perceived threats, rather than succumbing to the instinct to flee. Beyond the primal fear of loss, another powerful force compels investors toward panic selling: the siren song of herd mentality. Our brains are inherently wired to seek consensus, to find safety in numbers. In the complex arena of investing, this translates into observing what everyone else is doing and assuming that popular action must be the safest, or indeed the smartest, path. We see this reflected in market sentiment indicators, which often reveal extreme fear or greed precisely at the market's turning points. During a downturn, this tendency is amplified tenfold. Witnessing widespread selling across financial news, social media feeds, or even hearing it from friends and colleagues creates an echo chamber of fear. It fosters the illusion that everyone is selling, making the decision to join the exodus feel validated and less risky. This collective action, however, is often a shared mistake, a herd blindly following each other. The notion that the market is always right is a dangerous fallacy when applied to panicked selling. This assumes a collective wisdom that is frequently absent during periods of irrational fear. History is a stark testament to this, littered with examples where the herd was profoundly wrong, from the speculative frenzy of the Dutch tulip mania to the spectacular implosion of the dot-com bubble. To resist this powerful pull, we must cultivate a contrarian compass, develop a robust, independent investment thesis for each holding. When the market begins to panic, pause and ask yourself, is the fundamental value of my holdings truly impaired, or is this a sentiment sentiment-driven sell-off. If the underlying fundamentals remain sound, what appears to be a crisis for the herd can actually present a significant buying opportunity. Employ a pre-mortem analysis. Imagine your investment fails and meticulously identify the real reasons, not simply the superficial fact that everyone else sold. Herd mentality in investing is akin to a stampede. A few panicked animals trigger a chain reaction, with the rest following blindly, often heading directly towards danger. The contrarian investor, however, is the one who has the courage to stop, to assess the true situation, and to find a different path, even if that path means walking alone for a time. Our third trap on the path to panic selling is recency bias, the powerful illusion that this time it's different, and that recent events are somehow more permanent than they truly are. Our minds, by their very design, give disproportionate weight to the most recent occurrences. The vividness and emotional impact of a recent market downturn make it seem far more significant and likely to persist than the broader sweep of historical context might suggest. This cognitive quirk directly fuels panic selling. After a prolonged period of market gains, a sharp correction can feel jarring, almost like a betrayal. Recency bias leads us to forget that downturns, dips, and corrections are not anomalies. They are a normal, cyclical, and indeed necessary part of the investing landscape. The fear of a new normal of perpetual decline can then overwhelm rational thought, pushing us towards the exit. We must challenge the fallacy that current negative conditions are permanent impairments. Most market downturns, while undeniably painful in the moment, are temporary. History is replete with examples of economies and markets demonstrating remarkable resilience and recovery patterns. Recency bias blinds us to this fundamental truth. To combat this, we employ a time machine technique. Regularly review historical market data, specifically focusing on past recessions and recoveries, periods like 1974, 1987, 2000, and 2008. Understand the recurring patterns of fear, capitulation, and eventual rebound. Consider printing out charts that illustrate long-term market growth, including all the inevitable dips, and keep them visible as constant reminders. This practice anchors your perspective in historical reality rather than in the fleeting emotions of recent fear. Recency bias is like a sailor who focuses intently only on the immediate, stormy waves, completely ignoring the vastness of the ocean and the predictable underlying currents. Our time machine technique is akin to consulting navigational charts that reveal the ocean's true nature and its historical patterns, providing a far more accurate and enduring forecast. The fourth trap that ensnares investors and leads them to panic sell is the persistent illusion of control. Humans possess a deep-seated, almost primal need to feel like we are in charge, that we have agency over our circumstances. In the realm of investing, this often manifests as an overconfidence in our ability to precisely time the market, to predict its movements with uncanny accuracy, frequently fueled by anecdotal successes or the appearance of complex analysis. This illusion of control can paradoxically lead to panic selling. When an investor strongly believes they can predict downturns and exit at the perfect moment, only to find themselves caught in a decline, their sense of control is shattered. This loss of perceived agency triggers intense panic, often resulting in liquidation simply to regain a semblance of order and predictability. The evidence overwhelmingly demonstrates that consistently timing the market is an impossible feat, even for the most seasoned professionals. The most significant gains are often realized on a handful of critical days within a year, days that are invariably missed by those attempting to time their exit and re-entry. True mastery lies not in predicting the unpredictable, but in resilience. Therefore, we must embrace what can be called intelligent passivity and focus on pre-planned reactions. This means building a resilient portfolio based on fundamental value and a long-term strategy, rather than attempting to forecast short-term market gyrations. Crucially, define asterisk in advance, asterisk your criteria for selling an investment. This should be based on fundamental deterioration, not merely a price drop. Create a pre-approved action plan for various market scenarios. This removes the need for real-time, emotionally charged decision-making when volatility strikes. The illusion of control is much like a gambler who becomes convinced they can predict the spin of a roulette wheel. When their predictions inevitably fail, they might double down in a desperate attempt to regain control or walk away in a frustrated huff. Intelligent passivity, however, is akin to understanding the true odds, placing baits based on a solid, well-researched strategy, and having a preset, rational limit for any potential losses. The fifth and final trap that can lead to the destructive act of panic selling is confirmation bias. This is our inherent tendency to seek out, interpret, and favor information that confirms our pre-existing beliefs or hypotheses. It's a powerful psychological mechanism that helps us reduce cognitive dissonance, that uncomfortable state of holding conflicting ideas. During a market downturn, this bias takes on a particularly insidious form. When fear begins to grip us, we unconsciously start searching for news, opinions, and data that validate our burgeoning desire to sell. We gravitate towards bearish articles, dismiss bullish indicators, and interpret even ambiguous market news as definitively negative. This selective filtering reinforces our inclination to panic sell, making the decision feel not only justified but inevitable. What often feels like mere realism, a pragmatic assessment of dire circumstances, is, in reality, frequently confirmation bias at play. We are selectively filtering information to align with an emotional predisposition towards fear, rather than objectively evaluating all available data. To counteract this, we must actively practice the devil's advocate exercise. Make it a deliberate part of your investment review process to seek out dissenting opinions and data that challenge your current emotional state. If you find yourself leaning towards selling due to bearish sentiment, deliberately search for well-reasoned bullish arguments or data points that might suggest otherwise. Ask yourself, what information would genuinely convince me not to sell? Confirmation bias is like wearing blinders that only allow you to see the path ahead that confirms your current direction. The devil's advocate exercise is like momentarily removing those blinders to survey the entire landscape, to consider alternative routes, and to ensure that any decision to sell is based on comprehensive awareness, not on selective, fear-driven vision. We have journeyed through the often turbulent inner landscape of investing, dissecting the 5 behavioral traps that can ensnare even the most well-intentioned investor, leading them toward the destructive act of panic selling. We've confronted the potent fear of loss aversion, the seductive pull of herd mentality, the deceptive narrative spun by recency bias, the false comfort of the illusion of control, and the reinforcing echo of confirmation bias. These are not abstract concepts. They are the invisible chains that bind many to suboptimal outcomes. The transformation from a reactive investor prone to panic to a prudent one is not about eradicating emotions. That would be an impossible, and perhaps even undesirable, endeavor. Instead, it is about cultivating a profound understanding of these emotional currents and developing robust strategies to manage their impact on our investment decisions. It is about building that crucial emotional moat we discussed, a defense that allows us to navigate volatility with clarity rather than succumbing to fear. As a tangible step forward, commit to implementing just one of the techniques we've explored this week. Perhaps it's practicing the emotional rebalancing strategy when a portfolio dips, or actively engaging in the devil's advocate exercise to challenge your own bearish inclinations. The core objective is to begin decoupling your investment decisions from your immediate emotional responses, to pre-plan your reactions to market volatility so that they are rooted in logic and strategy, not in the heat of the moment. Warren Buffett, a figure synonymous with disciplined investing, once stated, "We don't have to be smarter than other people, we just have to be more disciplined." This discipline, he implied, extends far beyond market analysis. It encompasses the mastery of our own psychological responses, particularly when the market is testing our resolve. It is this internal discipline that separates fleeting speculation from enduring wealth creation. Ultimately, sustainable wealth is not built upon the foundation of flawless predictions, for the future remains inherently uncertain. Instead, it is forged through resilient decision-making, through the ability to weather storms with a steady hand and a clear mind. By understanding these pervasive behavioral traps and developing the strategies to outmaneuver them, you can begin to transform market downturns from moments of paralyzing panic into valuable opportunities for disciplined, long-term growth.